What's going on? I appreciate you taking the time to listen to this. So over the next month, I'm going to be sharing with you a 4-part video series about some of the critical aspects of real estate investing. So why am I talking about this? Well, we have a lot of experience with real estate investing because many of our clients, real estate makes up a significant portion of their net worth. That might be very true for yourself. And we work with people who are professionals in the real estate industry, from principals of private real estate investment companies, to real estate brokers, to do-it-yourself real estate investors, to people who have inherited real estate, and to other clients of ours who are driven to the allure of investing in real estate. And beyond that, we've also had some clients who become unintentional landlords through some of their prior real estate investments that they actually lived in and turned landlords. But we know real estate investing ourselves, and we know that what is currently taught about building wealth, about investing, has not left people in the greatest of positions. And it's also really clear that when you think about the financial services world, they're so biased by the traditional investment products that they can sell, and their planning is always shaped around that when it comes to stocks, bonds, mutual funds, ETFs, insurance products, and the like. And so we want to step away from that because we know that real estate, when done properly, can be an extremely powerful asset class to include in your financial life. But it has to be done properly. And so I'm going to be discussing 4 major components over the next month to real estate investing. And what I would suggest that you do is open up a document if you're in front of your computer and jot down some of the questions or comments that you may have. And when we get done with this 4-part video series over the next month, email them to me. Happy to set up a time to discuss them in more detail. So let's get started. Today, we're going to be discussing the 5 costly areas where we see investors go wrong with real estate. Now, why am I bringing that up today? Well, because why learn from your own mistakes when you can learn from the mistakes of others? We've had an inside view into many different real estate transactions through our clients' financial lives, as well as our own personal experience. We've seen what works. We've seen what doesn't work. So in our time together, I want to help you avoid the costly mistakes going forward. So let's jump into this. Mistake number 1 that we see is not having an ideal strategy or plan that fits your life, your goals, and your finances, where you're at in your financial life. So let me just jot that down. No plan. Now, what does this mean? It means that real estate investing, it's actually a business. And too many people are just throwing stuff at the wall and hoping that it sticks without a real business plan when it comes to their investments. When you invest in the stock market, you need to have a trading and investing game plan. When you open up a business or buy a business, your business needs to have a business plan. And real estate, the same thing holds true. You've got to have a plan that helps you articulate the systems, the structures, the returns that you're seeking to get from it. But beyond that, we've seen far too many people, because they're just throwing stuff at the wall and seeing what sticks, not have the right plan that fits the stage in their life. We've seen people who had a high-earning career and a growing family attempt to fix and flip homes on the side, thereby sacrificing their high earnings capacity career or sacrificing the things that are most important in their life, including their family. So it really needs to fit the stage of where you're at. You need to align those things, how you're investing with where you're at in your life. And beyond that, we've seen plenty of people enter the real estate investment game who might have high incomes, high tax brackets, and they're not managing their real estate investments to make sure that they're getting the highest after-tax returns and investing tax efficiently. So that's really important. And why are they doing this? Because mistake number 2 is emotional decisions. Many people make emotional decisions when it comes to their real estate. So let me jot that down. Emotions. That's critical that we get rid of these when we go to invest. Now, how do people stumble upon being an unintentional landlord? Well, they're not thinking through their investments. They're thinking that their home may become a good investment to keep, where it very well may not be when you think of all the other investment choices that are out there. Many people also come into cash in certain ways. They may get a bonus or they may sell a property. And then because they have this cash, they make an emotional decision and a suboptimal investment decision because you have idle cash and the fear of missing out or the greed pulls you forth to make these poor choices. And beyond that, many people don't sell an underperforming investment. That gets back to that unintentional landlord. If your home is not a good investment, why keep it? figure out what's best to do with your property in an objective manner and move forward. And other people who might not have ventured into the real estate world yet think that real estate might be a panacea for all their financial ills because of an infomercial that they've seen on TV. It does not work that way. So eliminate the emotional decision making when you go venture off in your real estate path going forward. Mistake number 3 that we see that ties into that is not knowing your numbers. Not enough people know their numbers. So let me jot that down. What does this mean? If you're going to be buying a real estate investment, you need to have a financial model and understand the returns that you may reap from it. You need to make sure that you've accounted for all the costs properly when you're going to evaluate the investment that you're going to make. I hear so many people say, hey, the rent that I'm getting from this property will cover your mortgage. Your mortgage? What about property taxes? What about insurance? What about repairs? What about lease fees? What about commissions? What about property management costs? What about your capital reserve for big expenses that are going to show up in the future? You need to have that all taken into consideration. And too many people are not doing their homework and knowing their numbers when it comes to their investments. But furthermore, even on investments that you already have, we've seen so many people not even understand the cash flow that's being generated from their investment properties. Or they don't know the actual rate of return that they're generating. So how do they know if that's the most optimal thing to keep inside their portfolio? And you also need to understand the time that you're committing and valuing that inside of this equation. Are you getting the return necessary to compensate you for the time that you're committing to this endeavor? And beyond that, if you don't know your numbers, you don't know your debt, you might miss out on valuable refinancing or financing opportunities that can improve your cash flow. So not knowing your numbers is critical. And this flows into mistake number 4 very highly. That is being comfortable with negative cash flow. Let me tell you that. Being comfortable with negative cash flow. Negative cash flow. For most people, they are far too comfortable with that. We see clients and we see friends when we talk to them about that, my rent covers my mortgage. Well, you're still forking out money in order to maintain that property. You need to be getting paid from your investments. You shouldn't be paying into your investment. That's not an investment. Put cash in your pocket every month. Yes, there might be investment situations where negative cash flow is a cost of doing business, such as fixing up a home and flipping it, or such as adding value to a property or playing something for an appreciation potential. But in terms of cash flow, if you want to be financially free and financially independent, you should be getting paid every month. You want your income to exceed your expenses. That is the formula for financial freedom. Don't be comfortable with negative cash flow. Find something that pays you, which gives you the opportunity to let the property appreciate over time. So that's very, very important. And mistake number 5, which ties this all together and goes back to the business plan, is not manage the property like a pro. Do you treat this like a true pro? You need to be fully committed to the time and work involved in order to manage your real estate investments. And beyond that, we see people who don't manage this like a pro, and they rationalize why they have below market rents, because they like their tenants, or because they don't want to spend the time trying to find new tenants. Well, this will cost you in the long run. It will cost your financial future. Unless you're a nonprofit, that's not the approach to take. Treat this like a pro. Screen out poor tenants. Have the right leases in place. Have the proper insurance. And manage this thing appropriately. So there you have it. 5 costly and critical areas where we see real estate investors, go wrong. So ask yourself, are you making any of these mistakes? Is your strategy congruent with your stage of life, with your finances right now? Are there any things that you can do to take your real estate strategy to the next level? Well, I hope so. I appreciate you taking the time to watch. Stay tuned for next week's video series where we're going to be talking about the hidden benefits of investing in real estate. We're avoiding the mistakes today. We're going to find out the benefits of when we do it right in the future. Thanks again. Talk to you soon.